So page 14 of your study guide, it talks about the double entry principle. So what is the double entry principle? So the double entry principle is for every, this can be illustrated as follows. So there's an account and there is a debit side and there is a credit side of the account. And the debit side is the left-hand side and the credit side is the right-hand side. So for each asset, liability, equity, expense, and income, there will be a T account in the books of the entity. All these T accounts together are called the general ledger. So with this, when you look at this double entry principle, can you see this double entry principle? I'm gonna make just a small, simple example regarding this double entries principle. So the double entry principle provides a logical method of recording transaction. In using the double entry system, the monetary value of each transaction must be entered on the debit side of the one ledger account, as well as the credit side of another ledger account. The entity in one ledger account refers to the corresponding entry in the other ledger account. So I'm going to give you an example for us to apply this double entry principle. So, for example, there is a company called Walton Stationers. So, what is the main form of business of Waltons? So, Waltons buys and sells stationery. So, you are now the bookkeeper or the accountant of Waltons. So, you are in a position whereby you're the bookkeeper or accountant of Waltons. So, Waltons buys and sells stationery. So I, Matilda, comes and buy stationery at Walton's. And I bought that stationery for 5,000. And I transferred, I did an EFT for 5,000. So you are now the accountant or bookkeeper of Walton Stationery. So basically now this is a transaction that happened. I, the customer, Matilda, came and bought stationery for 5,000 Rand. So my question to you is, number one, when I come and buy to you at Walton's and I paid by EFT, I paid 5,000. What must I get from you as the bookkeeper or accountant of that company? So I'm coming to buy from you. I'm the customer. What must you issue me? What should I get for buying that stationery worth of 5,000 Rand? So my question now is, you are now the accountant of Walton's. I'm the customer, Matilda. I'm coming to buy um, uh, stationery, and I bought stationery worth of 5,000. And my question is now is, what is the source documents? So my question is, what is the source documents? So number one, you as the accountant or bookkeeper need to issue me a tax invoice. So I need to get a tax invoice saying there was a cash sale. So I bought goods cash by doing an EFT for 5,000. So by me doing an EFT of 5,000, your bank statement will reflect 5,000 coming in to the business. So I'm saying to you, me as the customer, as Matilda, I need to get a tax invoice. You need to issue me with a tax invoice. So I'll get a original tax invoice. You'll be left with a duplicate for your records. And also another source document will be your bank statement. Your bank statement will be reflecting what? An incoming money 5,000 coming into your bank account. So that will be your source document. So the source documents is the documents that we'll be using for our transaction so that we can record in our books. So my question, so the other thing is, what is the next step? I've got a duplicate tax invoice that I issued to Matilda for 5,000, and my bank is showing money coming in for 5,000. So basically, at the end of the month, I need to decide, applying the double entry rule. What are the two accounts involved? Applying this double entry rule. So number one, there's a cash sale that happened. There's income coming into the business. So there is a sale for 5,000. Number two, there is bank. Bank is an asset. Money is coming into the Walton's business. So the two accounts involved here. So when we do the double entry rule, there must be two accounts involved. So number one, in this transaction, Matilda Hlahadi bought stationery at Walton's for 5,000 Rand, and Walton's issued Matilda with a tax invoice for 5,000 Rand, and they remained with a duplicate. And the bank account, because she did an EFT, the bank account of Walton's has a positive money coming into their bank account for 5,000 Rand. So I'm saying there is a two accounts involved. There is a sale. So for this example, guys, I'm just ignoring VAT. So in this example that I'm giving you, I'm ignoring VAT. So the two accounts will be a sale, money coming into account. Matilda bought stationery for cash and she did an EFT. So there is a sale. What is a sale? A sale is an income. And number two, there's bank, money coming into the bank account of Walton's. It's an asset. So how do these now affect this double entry principle? So an income, a sale is an income. And when a sale and income increase, you're gonna credit it on the right-hand side. And when bank is an asset, and when an asset increase, you're gonna debit on the left-hand side. So this is just a simple example I'm giving you guys just to explain this double entry principle. So number one, you need to find out what are the two accounts. So in this example that I've given you, it is sales and bank. Number two, is sales increasing or decreasing? So sales is increasing because in the business, there is more income. So it is increasing the income in the business. Is bank and asset increasing or decreasing? Bank is increasing because money is coming into the bank account of Walton's. Number three, you need to decide if so if income is increasing, do you debit or credit in your ledger account? When a sale and income is increasing, you're gonna credit it. You're gonna put it in the left-hand side. And if an asset, which is bank, is increasing, you're gonna debit it on the left-hand side. So this is just a basic example of the double entry principle. So before we do an example, any questions? Just need questions for what I just explained to you now. I just want us to do another example. So basically the double entry rule is provides a logical method of recording transaction. In using the double entry system, the monetary the money value of each transaction must be entered on the debit side of one ledger account as well as the credit side of the another ledger account. The entry in one ledger account refers to the corresponding entry in other ledger account. As the entries in the two ledger accounts has been entered on opposite side, the use of double entry systems allows cross references. So I want us now, there's another example for you I need to do with you regarding the double entry rule. I need you to understand this double entry rule. Guys, I want us to go through this double entry rule. This is how I want you to apply this double entry rule. So please note that the double entry rule, debit means left-hand side of the general ledger and credit means right-hand side of the general ledger. So basically, what are you debiting or crediting in the general ledger? You'll be debiting, crediting assets, liabilities, income, and expenses. That's the elements of financial statements that you'll be debiting or crediting in the general ledger. So when analyzing a transaction, I need you to ask yourself the following 4 questions. Which 2 accounts are involved in the transaction? Do the accounts form part of asset, equity, or liability? Did the asset, equity, liability increase or decrease? Which one of the accounts must be debited and which one of the accounts must be credited in the general ledger and the trial balance? So in this, so we're gonna do this first transaction. So the first transaction is Mr. Bingolis Tole, a qualified electrician, started a small service business, BS Electrical, on the 1st of January 2021. He decided to deposit 40,000 in the entity's bank account to start the business. So I'm gonna start here. So basically, you need to ask yourself these questions now. Which 2 accounts are involved in these transactions?
It's assets and equity.
So before you answer that, guys, I wanna go back to the example I gave you about Walton Stationery. So Matilda Hlagadi went and bought stationery worth of 5,000 from Walton's, and she received a tax invoice for 5,000. And Walton's retained a duplicate of that invoice for their records, and also in their bank account, because she did an EFT, in their bank account, they received 5,000 Rand. So my question is, on that example that I gave you, which 2 accounts are involved in the transaction?
Okay, I think it's asset.
So let me just repeat the question. So the question is saying Matilda went and bought stationery at Walton's and she received a tax invoice. She paid by EFT 5,000 Rand and she got a tax invoice and Walton's kept a duplicate tax invoice. So my question is, which 2 accounts are involved in this transaction?
Asset and expenses.
Okay, you said you're saying asset and expenses.
Yes.
Okay, thank you very much. I'm going to select somebody else. Thank you, Cynthia. So the question is, Matilda went and bought stationery at Walton's, and she bought that, the stationery was worth 5,000 Rand.
Yes.
And she received a tax invoice so you are representing Walton's. So you are the accountant or bookkeeper of Walton's. So now you
Okay.
issue Matilda you issue me with a tax invoice worth of 5,000. I paid EFT. So you issued me with a text invoice saying I bought stationery of 5,000. And then in your records, you've left with a duplicate tax invoice of 5,000, and in the Walton's bank account, there is 5,000 in because I did an EFT. So I'm asking you, with you having those source documents, which is your bank statement and that duplicate tax invoice, my question is now you need to apply the double entry principle. The first one is,
I think it's gonna be stationery and bank because they've paid with EFT.
okay, because Cynthia said expense and asset. Do you agree with her?
Yes, because stationery is also expenses. So yeah, I can say expenses and bank.
Okay, thank you, Jessica.
I think it's bank and asset.
So remember, bank is an asset.
Okay, so the
So
stationery won't fall under asset.
no, 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 no. So I need you guys because Cynthia and Jessica said expense and asset. So do you agree with them? I don't know. Or
So
should
it
I
is, so
repeat?
stationery would be an expense to the person purchasing, but you said we must look at it from the point of Waltons.
Yes,
So it's not
yes.
an expense for Waltons. So it would be stationery and bank.
So my question is, what are the two accounts involved? So remember, guys, you can either select asset, you you can either select asset, liability, income, expense. Those are the four elements of the financial. Those are the four elements of the financial statements. So I'm asking you, in the point of view that you're the bookkeeper or accountant of Waltons, if you want to apply the double entry principle, number one, I'm saying which two accounts are involved. So Shalini, you're agreeing with Cynthia and Jessica? Or
Yes.
okay, no, thank you. Blondie and Audrey is raising. Audrey, you can please come in. I can see you raising your hand. Audrey.
Hi,
Hi, Audrey.
how are you?
I'm very
Okay,
well, and you?
so I disagree with the two. I think
Okay.
it will be income and asset.
Income
Bank as an
and
asset and
okay.
asset.
All right. And then I see, thank you so much. And then I see
Okay.
Blondie also raised their hand.
Yeah, I also want to agree with Audrey because it's a sale that increased the income and then also the bank.
Okay. Thank you,
Thank you,
Blondie.
Blondie.
And then
And then
Rama Valley. I see you.
Yes, I think the latest speaker answered properly, sales and bank.
All right. Thank you so much, guys. Thank you so much. Thank you so much for all that contribution. I'm going to just repeat that question. So the question that I say to you is, you are the bookkeeper or accountant of Waltons. So there is a transaction that happened. Matilda came in and bought stationery at Waltons. Waltons' form of business is buying and selling stationery. What is the source of income, the source of revenue for Waltons? Is so my question before I just answer you guys is, you need to understand what is the source of income of the business. So in this case, what is the source of income for the business? So my question is, what is the source of income? Or so how do they generate their revenue? How does Walton generate their revenue?
they generate through sales.
Sales in what? Sales in what?
Stationaries.
Yes, yes, yes. So the source of revenue of Waltons is buying and selling stationery. So if somebody comes and buys stationery, it's a source of income, it's a source of sale, it's a source of revenue for Waltons. Are you with me, guys? Are you with me?
Yes,
If somebody comes and buys stationery, so in this case, Matilda came and bought stationery at Walton's worth 5,000 and she paid 5,000 rand. What is it? Number one, it's an income. It's money coming into Walton's. Money is coming into Walton's. It's not an expense for Walton's. It's income because they buy and sell stationery. They buy. So I just wanted to clarify the confusion with people, with a lot of students who were saying expense stationery. Yes. So in this case, because Walton's, their form of business is buying and selling stationery. When somebody comes and buys stationery, that's an income for them. That's an income. So I'm going to give you another example before we finish this double entry principle. If you are now the bookkeeper or accountant of VW, you are the bookkeeper or accountant of VW, the motor dealership. I come and buy a BMW for cash. So for example, I'm gonna just change this example. You're now the bookkeeper of BMW, VW, the dealership. Now, VW goes and buys stationery for their staff at Walton's. They go buy stationery for 5,000 for their staff from Walton's. I want you to tell me now, you're now the bookkeeper accountant of VW, the dealership, the dealership. What are the accounts involved? You now the bookkeeper or accountant of VW. You go and buy stationery at Walton's for 5,000. You pay um, Walton's 5,000 by EFT. What are the two accounts involved there? I'm just changing the scenario now.
Expense in the bank, and the bank increases now because I'm buying the stationery,
and so
income is also going to increase. It's not decrease.
Okay, so basically Blondie is saying expense and asset. Guys, do you agree with Blondie? So Blondie is saying now, because she now works at VW, she's the bookkeeper or accountant of VW, the dealership. They go to Walton's and buy stationery worth of 5,000. So you're now in position of what are the transactions in the books of VW? You went and buy stationery at Walton's now. What are the transactions now that you received a tax invoice as VW from Walton's? You paid 5,000 to Walton's. You in VW, what are your accounts? What are your entries? Do you agree with Blondie? Blondie is saying asset bank is decreasing and an expense that they bought stationery. Do you agree with Blondie?
Yes, I totally agree with Blondie.
Okay. Cynthia agrees, and everybody else? I see everybody else is quiet. So I just wanted you to see the difference in the two transaction, in the two businesses, how they dealing with the. So the main form of business of VW is buying and selling cars. So so if I went there to buy a car, that would be an income for VW. So now, let's just continue with this example. So we agreed that Matilda Tlhagadi bought stationery worth of 5,000 at Walton's, and she paid 5,000. So the two accounts there is asset and income. Number two is, do the accounts form part of asset, equity, or liability? So number one is sales and bank. Income or sales and bank. So a sale happened whereby stationery was sold by Waltons, and EFT, that the customer paid by EFT. So the two accounts involved is sales and bank. Number two is, do the accounts form part of asset, equity, or liability? So sales is form part of equity, it's income, and bank forms part of an asset. Number three is, did the asset, equity, or liability increase or decrease? So number three is, did the asset, equity, or liability increase or decrease? So the question is, did the asset, equity, or liability increase or decrease? Remember, we're talking about that example of Walton's, whereby the customer bought cash stationery worth of 5,000, and the two accounts was sales and bank. So my question is, in the books of Walton's, did the asset, equity, or liability increase or decrease? My question is, remember we're dealing with two accounts. I want to know on those two accounts. Remember number two, I said it's an asset and an income. So my question is the income, which is sales, and the asset, are they increasing or decreasing in the books of Walton's?
The income is increasing.
Okay.
I would say the assets are decreasing.
Okay.
In the first example where you came to buy the stationery, the asset increased and the income also increased. And then in the second one, the assets decreased and then also equity decreased.
So basically now I'm talking about the first example of a Walton's. You are in the books of Walton's. So
okay.
now we're just looking at Walton's. You are the bookkeeper accountant of Walton's. So I'm saying to you, in your books now, when there's an income and an asset, are they increasing or decreasing in your books?
They're increasing.
So are they both increasing? Because Ramavali is saying income is increasing, but bank asset is decreasing.
They're both increasing. The bank is increasing, also the income is increasing.
Okay, thank you, Blondie. So guys, we've got two answers now. Blondie is saying both are increasing. Ramavali is saying bank is decreasing and bank is decreasing and income is increasing. Yeah, guys, where others, please comment.
I agree with Blondie. They both increasing.
Okay, Cynthia is agreeing with Blondie, and then Audrey.
Yes, I also agree with Blondie. The bank and the income increases.
Okay, Audrey agrees with Blondie. So we've got two answers. Both income and asset are increasing, and bank is decreasing and income is increasing. Which one is right? Guys, which one is right? So the answer is, guys, remember so an asset increase when So I'm gonna just give you an example. So if there is, oh, I think I can see my chats. Let's see. Yeah, I can see my chats now. Tessa is saying, I agree with Blondie as the clients buy more revenue is generated. Yes. So guys, if your clients come or your customers buy from you, there's more customers coming and buying from you, buying from your business. They are increasing your revenue. So if there is money coming into the bank account, it is increasing your assets. If now I bought stationery that stationery that I bought with 5,000, if I bought that stationery and one of the stationery was faulty or something, and I returned some of the stationery, is that transaction gonna increase or decrease my revenue? That's going to decrease my revenue because I'm sort of like creating a credit note now. It's going to decrease my revenue. But if there is, I am selling my goods. I am increasing revenue in my business. If when I sell my goods, people, my clients or customers are paying, they are increasing my asset, which is bank. So if my clients or customers, they buy cash or credit, my asset will increase. So in a case whereby they buy on credit, there'll be a debtors account. That debtors account is, I'm buying now, but I'm going to pay later. So that debtors account or trade receivable account is going to increase. So if customers or clients comes and buy from your business, either for cash or credit, your income will increase and your asset will increase. If in the example of the other example of VW, so I'm going to refer to that other example of VW, whereby you now, the bookkeeper of VW, you bought stationery for the company at Waltons. So in that case, when you buy your expenses from Waltons, your expenses are increasing. So also in that case, so I'm going to give you the example of that scenario whereby VW, the dealership, is buying stationery from Waltons. So number one is expense and bank. Number two is asset and is expense, stationery, and bank account. Number two is an asset and an expense. Number three is the expense is increasing because we increasing our expenses in the business. So in everything, when you do your transactions, you are representing the business. The question is the business elements of financial statements increasing or decreasing? So the expenses of the business when they bought stationery from Waltons as VW, the expenses of VW are increasing. So why are we saying the expenses of VW after they bought the stationery of 5,000 from Waltons are increasing? We saying they're increasing because, let's say, for example, the expenses were before they bought that stationery. Let's say for the month of Jan, the expenses were 500. Now, in February, they're buying stationery again with 5,000 rand. Now, the expenses are moving from being 500 to being 5,500. Can you see that the expenses now are increasing in value? They're increasing. And what about bank? What about bank when the business bought when VW bought stationery for Waltons? What about bank account? Bank account, so I need to ask you that question. Remember, I explained to you the expense is increasing in the business because there is more expenses. What about bank? Because now VW bought stationery from Waltons. Is that bank account increasing or decreasing? So if a company buys asset or an expense for the business, the asset bank is decreasing because why? Money is going out of the business's bank account. So the asset, which is bank, is decreasing because they've bought stationery. They've bought stationery. That's why it's decreasing. So now, guys, let's continue. I'm going to do point number 4. Number 4 is which one of the accounts must be debited and which one of the accounts must be credited. So now we are in the example of Waltons. So in Waltons, the accounts we said was sales and bank bank is an asset, and the sales is income, and then forms part of equity. Number 3, the asset is increasing, and the income is increasing. Number 4 is which one of the accounts must be debited and which one must be credited. That's point number 4.
The bank must be debited and the income must be credited.
All right. Thank you, Blondie. Guys, do you agree with Blondie? Blondie is saying income will be credited and bank will be debited. Credit side in the general ledger and bank asset debit in the general ledger. Okay, I'm going to ask the question again. So the question is, when analyzing these 4 points, remember we now ask, I'm asking regarding this 4 questions when you want to determine the double entry rule. So the number 4 was like, which one of the account must be debited, which one of the accounts must be credited. So basically, Blondie is saying, and the others are saying, so Shalini is saying agree to disagree. so the question is asking is on the 4th point in so the question is asking you in the general ledger, where are you gonna record this transaction in the general ledger? Is it gonna be debit, credit? Yeah, that is the question. The question is the sale that happened in the books of Waltons. That sale of 5,000. That sale that income is increasing and asset is increasing. In the general ledger, how is this going to be recorded?
Okay, I think we're gonna debit the assets and then credit our liabilities.
So Jessica, you are now, because people are talking about, so you just repeat your answer. So my question is the last point when we now determining the double entry principle. The last point is saying which one of the accounts must be debited and which one must be credited in the general ledger. So we're talking about now the sales that happened. So the question is the 5,000, the sales account and the bank account. So the question is, guys, is the sale of 5,000, is it going to be debited or credited in the general ledger? And the bank, the money that came into the bank account for 5,000, is it going to be debited or credited in the general ledger? That is the question. And the answer is, Blondie said, she said that the sales, the income will be credited in the general ledger, and the bank will be debited in the general ledger. So I just want to show you this. So can you see, guys, look at page 14 of your study guide. So page 14 is illustrated as this. Credit sales, credit sales and debit sales. So Jessica is saying that. So for those who are still confused, when an asset increase, you debit the asset in the general ledger. When an income increase, you credit the income in the general ledger. I'm going to just repeat that again. If an asset, which is sale, which is money coming into the business of Waltons. So Waltons sold stationery worth 5,000 Rand. So when Waltons sold stationery worth of 5,000 from sold the stationery, that sale, it was a cash sale. So meaning money came into the bank account of Waltons. Sales and bank, that is the two accounts. Sales is income. Income form part of equity. When income increases, equity increases. Number two, bank. Bank is an asset. And when money coming into the account of the business, it's increasing the assets of the business. So in this case, when an asset increase, you will always debit that asset in the general ledger. When an income increase, you will always credit that income in the general ledger. This is this double entry principle. So basically there'll be an account here. So when you see where there's account here, it'll be sales, it'll be written sales, and it will be 5,000 on the credit side. And then there will be another general ledger account. This will be the account bank, and the account will be left-hand side will be debited with 5,000 Rand.
I still need clarity about the banks, and because I'm a bit lost.
Okay.
And then, yes, and then I haven't got my study material yet.
No problem, no problem.
Yes, so if you can explain again where you're saying the income increases, the equity also increases, and the bank, that part, like I'm still lost.
Okay,
Yes.
so I want to explain to you where is this coming from. This is coming from your page 14. Page 14 of your study guide. That's called the double entry principle. So I'm just showing you guys how to apply that. So I'm showing you how to apply this on 2.6 double entry principle. This is now me showing you how to apply that. So number one, so basically the transaction was you now Nosipo, you are the accountant. Now you've been appointed of being the accountant of Waltons. Now I come as Matilda, I come to buy from Waltons. I bought stationery from Waltons. So you at the end of the month, so let's say I bought that stationery in January. So at the end of the month, you need to do your books and you've got your source documents. What is the source document? Will be that duplicated invoice and the bank statement. So basically now I'm saying I bought in January stationery worth 5,000 Rand and I paid by cash, EFT. So at the end of the month, which is January, I need to record my transaction in my books. So different companies use different accounting softwares. So there's Pastel, there's QuickBooks, there's Maconomy, there's SAP. So there'll be different kinds of accounting software you'll be using to record these transactions. So you've got a source document, which is the duplicate invoice that you got from Matilda, who bought stationery, but Walton sold to Matilda. Walton's sold stationery worth of 5,000 Rand. So there is a source document that now you're looking at. Matilda's got her stationery, but now you given her an original tax invoice. You left with a duplicate. The bank account, Walton's got 5,000 in the bank account, in the actual account. Now, with you having that transactions, you need to just record these transactions. But now you need to know which accounts are they. Number one is you now understanding the double entry principle. These are the 4 questions you need to ask yourself. Which 2 accounts are involved? Sales and bank. Why sales? Sales is income. Money came in. Matilda bought stationery for Waltons for 5,000 Rand. Why bank? She paid by EFT. So money came into the bank account. Number 2, do the accounts form part of asset, equity, liability? A bank is an asset and sales or income forms part of equity. So what is equity? Equity is income and expenses. So equity is at the end of the month, what is the owner getting? What is the owner? Did the owner make a profit or a loss? So income less expenses form part of equity. So in the equity account, as a business, you'll be able to see that is the company making a profit or a loss. So if your equity is increasing, meaning the company is making a profit. If the equity is decreasing, meaning the company is making a loss. So your income and your expenses will affect your equity account. So if they say equity is increasing, they meaning your income are increasing. If they is saying equity is decreasing, so meaning the company is making a loss, there's more expenses in comparison to income that happened for that period. So number 2, in this case, income equity is increasing. The third point is, did the asset, equity, or liability increase or decrease? Because money came into the account, equity is increasing. Number 3, bank is an asset. Money came into the bank account, assets of Waltons are increasing. Number 4, which one of the accounts must be debited and which one of accounts must be credited? Asset, when an asset increase, you debit. When an asset decrease, you credit. When income increase, you credit. When income decrease, you debit. When an expense increases, you debit the expense. When an expense decrease, you credit the expense. I'm just going to repeat that again. If an asset increases, you're gonna debit the asset in the general ledger. If the asset decrease, you're gonna credit the asset in the general ledger. If income, which is a form part of equity, if income increase, you're gonna credit income in the general ledger. If income decreases, you're gonna debit income in the general ledger. If an expense increases, you're gonna debit the expense in the general ledger. If the expense decreases, you're gonna credit the expense in the general ledger. I want us to do this quick exercise. I've got 4 transactions, and I just want for you to answer those questions on those 4 transactions. I want us to apply the double entry principle on this 4 transactions. So this transaction here, transaction 1 to 4, I'm going to start with the first one. So the first one is Mr. Bungole Sithole, a qualified electrician, started a small service business, BS Electrical, on the 1st of January 2021. He decided to deposit 40,000 in the entity's bank account to start the business. So I want us to apply the double entry principle. So how do we apply that? I want us to answer these 4 questions. So first of all is which 2 accounts are involved in the transaction? So Mr. Sithole is a qualified electrician, started a small business. So in this transaction, where are you? You are the bookkeeper or accountant of BS Electrical. So you need to now record transactions. You need to be able to understand this transaction here. So Mr. Bungoli has appointed you as their bookkeeper or accountant to do their books. So he now, what does he do? He gives you a bank statement. You're now looking at the bank statement at the end of January. And on the bank statement, you see 40,000 in the entity's bank account. And you, as the accountant or the bookkeeper of BS Electrical, go to Mr. Sithole and ask, what is this 40,000 for? So he comes to you and said, this 40,000 deposit is to start my business. This 40,000 I used to start this business of BS Electrical. So the question is, how are you going to record this as you are now the accountant or the bookkeeper of BS Electrical? You look now, your source document, you're looking at the bank statement now. You're looking now at the bank statement. So because now when a business, when an owner starts a business, the money that they start the business with is called capital. So that money that a business starts, the owner starts the business with is called capital. So the accounts that are involved is, when you're looking at that bank statement, is capital and bank. The accounts that will be, the 2 accounts that will be there is capital and bank. What is capital? Capital is the same as forms part of equity. It's the money that the owner contributed to the business. So capital forms part of equity. So number 1, the 2 accounts are capital and bank. So capital is equity. Number 2 is, do the accounts form part of asset, equity, or liability? Capital forms part of equity, and bank is an asset. Number 3, did the asset, equity, liability increase or decrease? Did the capital account increase or decrease? Did bank increase or decrease? That is number 3. Did capital?
The bank increase and the capital increase.
Okay. Thank you, Blondie. You can, guys, comment on the chat. Can comment on the chat. So Cynthia is saying both increase. Okay. Shalini, both increased. Shalini is saying both increase. So Mr. Bongole Sitole hired you as a bookkeeper accountant of BS Electrical. You, at the end of the month, you need to do a bank reconciliation. You need to do a bank recon. So because you're looking at the bank statement, you need to record this in the subsidiary journal, which is the cash book receipt account. So when you record this account, you need to know that you need to what? Debit or credit. Is this gonna increase or decrease your bank account? So this is definitely gonna go to your cash book receipt. And this is gonna, number 3, equity, because you as the owner contributed money to the business. You, the owner, contributed money to the business. The equity account is going to increase by 40,000. And because money came into BS Electrical bank account, the bank account of BS Electrical has increased by 40,000. So number 4 is, which of the accounts must be debited and which of the accounts must be credited in the general ledger and the trial balance? Which account here must be debited, must be credited?
I think we debit the bank and we credit the capital.
Let's see. Is it Fifi? So Fifi is saying debit bank, credit capital in the general ledger. And Shalini said asset debited, equity credited. And Andy is saying asset debit, equity credit. That's Andy there. And then number 4, so everybody is saying asset debit and equity credited. Jessica is saying asset debited and equity credited. So everybody is agreeing with the same thing. Guys, on top of this, I want to add something. I want us to do the same time the accounting equation on this 4 transactions. So I'm gonna, before I add accounting equation on these 4 transactions that we're doing, I'm just gonna show you the accounting equation. So accounting equation states that asset equals to equity plus liabilities. That is the equation. So you can either say A equals to E plus L, or you can say equity equals to asset minus liability. So in the example of Walton's, I want us to put in the example of Walton's. So we know that in Walton's, Walton sold stationery worth of 5,000 for cash, and they received a cash for 5,000. So when you do the accounting equation, you must put there plus or minus. So plus will say increase, minus will say decrease. So in this case, for Walton's asset here, because the accounts that was involved was asset and income. So we said asset is increasing and income is increasing. So when you do the accounting equation, it's gonna be plus 5,000 under asset plus 5,000 under equity. Are you with me?
Yes.
So when you do the accounting equation, it's you applying this. This is you're just making sure that this transaction balances. This transaction, make sure that it balances, because if I say plus 5,000 equals to 5,000 plus, because liabilities, there was nothing, it's going to be plus 0. Can you see that this transaction balances? So it's going to be 5,000 equals 5,000 plus 0. Or you can look at this accounting, look at the bottom equation now. Our equity is what? Is 5,000. So you want to say 5,000 equals to 5,000 minus 0. Can you see when you also use this one also, it also balances? Can you see that it balances? So I'm going to repeat this again in the example of Walton's that we did. When you do the accounting equation, you applying just this equation. You're applying this equation. So when you apply this equation, you are saying, remember, our last step of the double entry principle is which one of the accounts must be debited, which one must be credited. So in this case, I think in this double entry principle, you're going to apply rule number 3. So when you do the accounting equation, I want you to look at number 3. Did the asset, equity, liability increase or decrease? So in this case, in our example with Walton's, Walton's sold stationery for 5,000. So you're gonna, what are you doing number 3? Bank asset, it's what? It's increasing. And income is increasing. So when both your asset and your income are increasing, you're gonna put plus 5,000 here, plus 5,000 under equity. Can you see that your transaction balances? There's transaction balances. So I want you now to confirm with me if you agree or disagree with me. The example of VW, whereby VW bought stationery at Walton's for 5,000. How is this gonna affect your accounting equation? So VW bought stationery for 5,000 by EFT. So the entries was bank and expense. So number 3, remember when we did that, we said asset bank is decreasing by 5,000 and expense 5,000 is increasing. How is that going to affect your accounting equation?
The bank will decrease, and then expense account will increase.
Blondie. So Blondie, you're saying, so I want you, when you answer this, remember the first example I said, you need to put in what's important about the accounting equation, put in your plus, your minus. So you need to tell me, oh, under asset, I'm going to say plus or minus, under equity plus or minus 5,000.
Under assets is minus 5,000.
Okay.
And then under expenses is gonna plus 5,000.
Okay. Before you mute, is your transaction balancing?
No.
So remember the trick with accounting equation. Your transaction needs to balance. So I'm gonna repeat. So I want you to review your answer again. I'm gonna repeat that answer for Walton's, the first example. So I said in Walton's, it was asset and income. And I said plus 5,000 asset plus 5,000 because why? It's increasing, plus 5,000 under equity because income is increasing. So if income is increasing, it's increasing equity.
Oh yeah, right now I understand. The bank where it's minus.
Okay.
And then on the equity also it's minus.
All right. Okay. All right. Thank you, Blondie. Guys, do you agree with what Blondie is saying? So Blondie is saying the asset will decrease by 5,000. So here will be minus 5,000 and under equity will be minus 5,000. So the one thing that I need you to always remember, and also maybe just write it down somewhere. When you do the accounting equation, income will always increase equity. When an income increase will always increase equity. When expenses increase will always decrease equity when you do your accounting equation.
Sorry, can you please repeat?
When you do the accounting equation, income will always increase equity. So when income increases, will increase equity. And when expenses increase, they will decrease equity. I'm going to repeat that again. When you do the accounting equation, your income, when income increases, it will increase your equity. When your expenses increase, they will always decrease equity. Your income, expenses, capital, drawings will always affect equity. So guys, please, 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 when you do the accounting equation, make sure you putting the sign. So now Blondie is saying minus 5,000, a bank minus 5,000 expenses. Can you see that plus 0 here? Can you see that your transaction balances? Your transaction balances. So it's all about putting the plus, the minus, and the element of financial statement, which is asset, liability, income, and expenses. So in this example that we're doing now, example 1, this example one that we're doing. So we said that, what did we say? We said that two accounts are capital and bank. We said that do the accounts form part of asset, equity, and liability? We said bank is an asset and bank is an asset and capital contribution is equity. Number 3 is, did the asset, equity, liability increase or decrease? Equity increased and bank increased. Number 4, which one of the accounts must be credited and which one must be debited? Bank is an asset, and when an asset increase, you debit. Capital is equity. When equity increase, you credit. The question that I have is, how will this affect your accounting equation? How will this affect your accounting equation? The two accounts is capital and bank. How will this affect your accounting equation? How will this affect your accounting equation? The two accounts is bank and capital. Bank is an asset and capital is equity. Asset is increasing and equity capital is increasing. So point number 3 will determine how will you answer your accounting equation. Number 3. So number 3, I said asset bank increase, capital equity increase. So how would you balance this equation now? Capital 40,000 and bank 40,000.
The assets are gonna be plus 40,000, and equity is also gonna be plus 40,000.
Okay, Blondie. Guys, do you agree with what Blondie is saying regarding the accounting equation? Do you agree with Blondie?
Yes, I agree.
Fifi agrees. Fifi agrees.
Ramavele agrees.
Oh, Ramavele agrees.
Yes, we agree.
Ah, well done, guys. Well done. I'm impressed, eh? Well done. I'm impressed. Let's do I want us to do transaction number 2. Let's do transaction number 2. So transaction number 2 is saying, on the 15th of Jan 2021, BS Electrical bought toolbox and tools to be used by Mr. Sitole on credit from big builders for 7,000. So basically what's happening here is this is an electrical company. So the owner of the business bought toolbox and tools to be used so these toolbox and tools are gonna be used for him to perform his work, for him to generate revenue. So this toolbox and tools are gonna be used for him to perform services to customers. So he bought this toolbox and tools from big builders on credit. So especially when you look at the transaction, what was bought? Toolbox and tools, that is number 1. Did they buy cash or credit? In this case, this was bought on credit for 7,000. So that will be you will be able to determine the accounts by you determining, did the business buy or pay? Did they buy or pay? But in this case, they bought. So the question is, what did they buy? Did they buy asset, liability, or an expense? And did they buy that asset, liability, expense, cash, or credit? So now you need to determine is what is a toolbox and tools? Is this asset, liability, or an expense for BS Electrical? And did they buy cash or credit? So my question is, which two accounts are involved? What two accounts are involved?
I'm not so sure about it, but I think the bank and a big builders, which is a creditor.
Okay, so you're saying two accounts are?
Bank and the creditor, which is the big builders.
Okay, so you're saying bank and creditor.
Yeah.
All right. Guys, please, Blondie, it's saying it's bank and creditor. What do you think? So I'm going to just repeat that, what I said. When you're determining which two accounts are involved, this needs to come into your mind. Is the business buying or paying? So in this case, we determine that it's buying. What is buying? It's buying toolbox and tools. So you need to decide if toolbox and tools is that an asset, liability, or is that asset, liability, or an expense for BS Electrical. And we determine that BS Electrical bought this toolbox on credit. So you need to determine already here, the scenario is giving you what is the two accounts. So guys, the two accounts are toolbox and tools. So I'm going to call it toolbox equipment. So basically, this is an asset that the owner is going to be using for a couple of years to perform his service to his clients. Because remember, this is he's an electrician. Yes, he's an electrician. He's an electrician. Shalini is saying equipment and creditors. Shalini is saying equipment and creditors.
I agree with Salini.
Are you with me, guys? Shalini is saying equipment and creditors. So remember, you need to, when you look at the transaction, who am I in the transaction? You are the bookkeeper or the accountant of BS Electrical. What did we buy as BS Electrical? We bought toolbox. What is toolbox to BS Electrical? That is equipment, toolbox equipment. And did we as BS Electrical bought this cash or credit? That was bought on credit from big builders. So guys, can you see the two accounts are what? I agree, Shalini. Shalini is saying equipment and creditors, and Blondie agrees with Shalini. So it's toolbox, equipment, and creditors. Fifi agrees. Fifi agrees. What about the others? Jessica, Nozipo. Oh, Nozipo, I agree. Andy, Jessica, Rama Vele, and Type Singh, Cynthia, I didn't see Cynthia. Saying agrees. So guys, why are we saying this is toolbox equipment and creditors? We are saying that because BS Electrical bought. So what is a transaction? A transaction is whereby a business buys or pays. A business will either buy asset, liability, or buy. So businesses will either buy an asset or a liability, or they will pay an expense or a liability. So those are transactions that the business will, or they'll also sell cash or credit. So when you determine what are the two accounts, you need to put yourself in the shoes of the business. Who am I? Oh, okay. I'm an accountant, a bookkeeper of BS Electrical. So we, as BS Electrical, what are we doing? Are we buying or paying? We're buying toolbox and tools, which is an asset that will be used for the owner to provide a service to his customers. Number 2 is, do the accounts form part of asset, equity, or liabilities? Do the accounts form part of asset, equity, or liabilities? Andy is saying asset and liability. So basically, asset is bank, and then liability is the creditors. So asset is bank, and asset is bank, and liabilities is creditors, big builders. The asset is toolbox equipment. Number 3, did the asset, equity, liability increase or decrease? Did the asset, equity, liability increase or decrease?
It increases.
Remember, it's two accounts, eh? What? So you're saying both are increasing?
Assets are increasing.
Oh, so you're saying assets are increasing and then liabilities? So guys, Cynthia is saying assets are increasing. Do you agree? So Ntabi saying it's saying they both increase. Andy is saying both are increasing. Charlene is saying both are increasing also. So the BS Electrical bought an asset. So they've got more asset into their business. And also their liabilities are increasing. You're well done, guys, eh? You're well done. I'm so impressed. I'm so impressed. Yes, they're both increasing. Which one of the accounts must be debited and which one must be credited? Which one of the accounts must be debited and which one must be credited in the general ledger?
And the equipment must be debited and the liabilities must be credited.
Okay, all right, okay. All right, Blondie. So Blondie is saying asset, debit, liability, credit. Tabi saying asset, debit, liability, credit. Andy, asset, debit, liability, credit. Shalini, asset, debit, liability, credit. Let's hear what Jessica is saying. So overall, everybody's saying asset, debit, liability, credit. Yo, guys, well done. I'm impressed. Yes, asset is increasing, you debit. Liabilities increasing your credit. Well done. And how are you gonna apply your accounting equation now? Remember, the trick is make sure your equation balances. Make sure your equation balances. How will this affect, how will this transaction affect your accounting equation? Equipment, debit 7,000, creditor, credit 7,000. Equipment is increasing and creditor is increasing. How will this affect your accounting equation?
Asset is going to be plus 7,000 and the liability is also going to be plus 7,000.
Can you see that your accounting equation balances?
Yes.
Yeah, okay. Thank you, Blondie. Thank you. Guys, do you agree with Blondie? So Blondie is saying plus 7,000 assets, bank, plus 7,000 asset, toolbox, plus 7,000 creditors, so basically the equation will be plus toolbox 7,000 plus 0 for equity and then plus 7,000 for creditors. So it's important to put that plus or minus, but at the end of the day, your equation needs to balance. 8 equals to 8. It needs to balance. Ntabiseng agrees. So guys, everybody is agreeing. Can you see? So I want us to do yes, Ntabiseng agrees also. Let's do transaction 3. So transaction 3 is on the 18th of January, BS Electrical bought a letter from Letters Pty Ltd and paid for it by EFT 1,200. Which two accounts are involved? So the question is, on the 18th of January, BS Electrical bought a ladder from Letters Pty Ltd and paid for it by EFT for 1,200. Fifi Equipment and Bank. Fifi Equipment
I
and
also
Bank.
agree with Fifi. It's a bank and equipment.
Okay, all right. Thank you, Cynthia. I agree, okay. Blondie agrees with Fifi. Blondie agrees with Fifi.
I also agree with Fifi. The letter will be equipment and EFT will be bank.
All right, okay. Thank you, guys. And then do the accounts form part of asset, equity, and liability?
I think it's asset and liabilities.
Okay. Ntabiseng is saying asset and equity. Andy is saying asset and equity. Asset and equity. Guys, I'm equipment. Who's that? Ntabiseng is saying asset and bank. So guys, the two accounts that are involved there, let's see. The two accounts that are involved there is asset, which is the ladder equipment, and because they paid it by EFT, it's bank. So the two accounts is the ladder, which is the equipment, the asset, and bank. That's the two accounts. I think Ntabiseng got that right. Do you understand why it's asset and bank? Not equity. It's assets and bank. And then the third one, did the asset, equity, liability increase or decrease? Did the asset, bank increase or decrease?
I think it decreases.
Let me just see. So basically, number two, do the accounts form part of asset, equity, and liability? Number two is assets, guys. Both are assets. I think Blondie is correct. Blondie is correct. Assets. It's only assets. Blondie, correct. It's only assets. The ladder is office equipment, which is asset. Bank is an asset. So it's only assets, no equity. Blondie is correct here. It's two assets involved, which is bank and equipment. There is two assets involved. So did the assets increase or decrease? Did the assets increase or decrease? One asset increased, one asset decreased. So the bank decreased because money we've paid and bought a letter, and one we bought a letter, so it increases increases one of our assets. So number three is one asset, which is bank, is decreasing, and the letter office equipment is increasing. Number four, which one of the accounts must be debited, which one must be credited? Bank. So Blondie is saying bank credited, equipment debited. Yes. So bank will be credited because bank is yes. Andy the same. Andy, equipment debited, bank credited. Yes, guys. I think debit, equipment, credit, bank. Yes, Fifi, that is correct. The question is now, how will this affect your accounting equation? How will this affect your accounting equation? That is correct. Equipment will be debited and bank will be credited. How will this affect your accounting equation? How will this affect the accounting equation?
I think it's going to give us a nil effect, since it's going to be a bank minus and then equipment plus 1,002.
Yes, guys. The effect will be nil. So it will be minus bank under assets. How much is it? 1,002 plus equipment 1,200 and equals to 0 equity plus 0 equity. Can you see that it's 0 equals to 0? Our equation balances. Our equation balances.
Mm-hmm. It does.
Guys, well done. We just did double entry principle and accounting equation. How do you feel? I think we've come to the end of our class.